We just welcome all of you back this evening for our next installment of Godly Finances, and we'll just start with Father and an opening prayer.
In the name of the Father, and of the Son, and of the Holy Spirit.
Amen.
Father, we thank you for this opportunity to gather together once again so that we might truly put our material needs and all of our material blessings into your hands and surrender them to you so that you might take control of everything we have, everything we are. And Father, we ask that you bless our time together so that we might be inspired by the Holy Spirit to hear exactly what it is that you are trying to tell us. And Father, we pray that all of these things will bring glory to you. And we pray, Lord, loving Father, who feeds the birds of the air and arrays the lilies of the field, your care for us knows no bounds. By the power of the Holy Spirit, grant us the grace of an ever deeper trust and dependence on your care and protection. Inspire in us a radical generosity and discipleship that mirrors your own bottomless generosity and will form us into the sons and daughters you created us to be. With you in all things are possible. Please enliven our hearts with a desire to do all that we can to free ourselves from the burdens of debt, pride, and fear, so that reborn into the glorious freedom of the children of God and building on a firm foundation, we can focus on sharing your love with the world around us. We ask all of this in the name of Jesus and through the intercession of our Blessed Mother Mary, Saint Joseph, and Saint James. Amen. Amen. In the name of the Father, and the Son, and the Holy Spirit. Amen.
Last week I shared just a simple philosophy of save more than you spend and spend less than you make, and that you'll be in decent shape. So we're blessed to have with us this evening Cody Roos, which you'll notice, which is very nice, he's a little bit younger than Father Bryce and myself, and so we wanted to be able to have the gift of a young father, as Zach Payne, who presented a little bit and will present again next week, just to have the perspective of a young family starting out and recognizing what is it that we can do to save, to really take advantage of those goods that God has given us and use them in a way that can both help us now and in the future. So we thank Cody for willingness to share his gifts with us this evening.
Alrighty, so we'll see how this goes. I did a little bit of rehearsing, but this could be way too long or it could be way too short, so just bear with me. We'll see how it goes. My name's Cody Roos. I'm a parishioner here at St. James. If you go to Mass on Sunday evenings, you might come across my wonderful wife, Nicole, who's in the back there, my daughter, Roos, or my son, Peter. I'm looking forward to talking to all of you tonight about preparing for the years of famine during the years of plenty. I'll give a brief background about myself, and then I'll just dive right into it. I grew up on a small dairy farm in Tillamook, Oregon. Our cheese and our ice cream have made it this far east, so that was kind of exciting. I met with my wife in college, got married, had our daughter, moved all the way across the country, then had our son. Throughout all of that wonderful craziness, I worked in tax preparation and bookkeeping at a small CPA firm. I actually worked for the Knights of Columbus for a little while for their insurance services, and then financial advising for a credit union. And ultimately, I found the best way to accomplish what I was being called to do for work, while maintaining the flexibility that I needed for my family at home, was to form my own registered investment advisory firm and my own accounting firm. So I work completely remotely from home, which has been a wonderful blessing so far. Now, the older I get, the more I realize I really don't know very much. I find it humbling that God created every little thing in existence, and he knows all of it. He knows everything about all of it, which is just amazing to me. But what a blessing it is that we have the free will to seek and understand even a portion of what God has created. On that note, I've been blessed with a strong curiosity for just about every area of finance. My wife doesn't quite understand why listening to podcasts on tax strategy is something that I enjoy doing on my free time. But for me, it allows me to expand my knowledge to help my family eliminate finances as a barrier to achieving God's will for our lives. And so I feel very called to help other people with that same goal. And so if I can be a resource to anybody in any way for what I know and able to share my knowledge, I'm happy to do that for you guys. for anybody for that matter. I went through a Catholic marriage preparation course in Corvallis, Oregon with Nicole. We went through a long pre-marriage questionnaire. There were many different sections in that questionnaire, and I remember that the higher you scored, that was a good indication that you were in pretty good alignment as a couple, and the lower scores indicate areas you might need work. I remember there was one area that Nicole and I excelled in, which was finances. And the couple that had been doing it for many, many years, that was our sponsor couple for the questionnaire, said they've never seen anybody score 100% on a section. Nicole and I scored 100% on a section. And we have certainly had our ups and downs in our marriage. There's been a lot of down points, but one thing that has really helped us is we're on the same page financially. We're both very frugal people. We don't like wasting money. We don't like taking on debt. And that has been a good rock in our marriage, because no matter where we're at, finances is something that we never have to worry about struggling with. And that can create, as many people know, a lot of strife in a marriage. Let's see here. I wanted to share that to help summarize or emphasize the importance of being on the same page as your spouse financially, understanding each other's goals and priorities and how it aligns with God's plan, and having a plan in place to get it done will only benefit your marriage and your family. Ultimately, financial planning doesn't have to be complex. Some people hear financial planning, they think, oh, you have to hire a professional in order to get started. But the fact of the matter is, you can start on basic financial planning yourself. It can be kind of a fun activity, especially if you're involving your family. Like, for example, I might ask Rose, hey, Rose, do you want to go to the zoo with just Nicole, and I can stay home and work so that I can afford to pay for the trip to the zoo? Or do you want to just stay home and play board games as a whole family, and then I don't have to worry about paying for the zoo, so I can afford to stay home and play games with family? So just little things like that. That's a very small example, but that's just one example of many how you can involve your family and make it kind of fun as well. So let's see. Additionally, financial planning, especially as a married couple, can provide peace of mind. And I apologize for my chicken scratch, but just bear with me on that. It can also minimize marital issues caused by finances, and it can create some great opportunities for discussion. So, I actually sent you, or gave all of you guys a paper that has some good, hopefully thought-provoking questions on it. It should be the one-page financial snapshot. And it has some pretty good points on there. But ultimately, I want to drive home the point that money is just a tool that can be used to help us accomplish God's will for our lives. So money is just a tool. That's pretty much all it is. Whether that be raising a family, or bringing others closer to God, or providing for yourself, your family, or others, whatever your goals may be, money is just a tool to help facilitate those goals. And then, like I mentioned, we have the one-page financial snapshot that should allow you guys to answer some pretty thought-provoking questions regarding your personal finances. I'm going to go over actually 8 kind of areas of financial planning. And that was the other paper that I gave you guys. Those 8 areas include starting with clear goals, creating a realistic budget, building an emergency fund, managing debt wisely, automating savings, investing for growth, reviewing and adjusting for life as it comes, and then diving into the details, which that's a pretty fun part. I'll get into that towards the end. So we'll start with, let's see, goal setting. So I'll go ahead and, just as a reminder, we are on goals. All right. And as far as goals go, consider where you want to be. What are your goals and your values? What drives you? What gets you up in the morning? Involve others, pray, and reflect. I mean, a lot of times, especially for me and my family, we want to align our goals with one another. So if our goal is to take a big trip across the ocean to Europe one day, I want to make sure that everybody's on the same page. Because if the kids are like, oh, I don't really care to travel much, I don't really want to be pushing a goal that not everybody's on board with. So involving the families is helpful in that regard. I recommend going through that questionnaire that I provide for you guys just on your own time and discussing it with your spouse and maybe even your children, just to get a better idea of where everybody stands with it. Secondly, we'll move on to creating a realistic budget, and I know Bryce, actually I know Nick, I believe, and his wife will be touching a little more on budgeting. But I'll cover a little bit here. One thing that I like doing for my own personal finances is, so you have the necessities where you can list out all the expenses that you know are going to be there no matter what happens. So think of your mortgage or your rent or your food bill or utilities, those things that you really can't avoid. Insurance costs. To some extent, insurance, you might be able to find a little savings, but for the most part, they're fixed, and those are going to be expenses that you're going to be on the hook for no matter what happens. So go ahead and list those out, and then as far as discretionary spending goes, so whatever's left over afterwards, there are three classifications that I like to use to say, okay, should we allocate some of our funds to these discretionary expenses? The first is the question, does it enrich our relationship? So the important relationships in your life with your spouse or your kids, does it help those relationships? Secondly, does it provide for valued experiences? So if traveling is something you want to do, if helping provide food for the hungry is something you want to do, does that discretionary expense allow you to do that? And then thirdly, does it align with your purpose or your goals in life? So is your goal to raise a family and send them all to college? That's going to check mark that box. So typically, if you can align with two of those three boxes, so we're talking about relationships, valued experiences, and your purpose, your goals, that's usually pretty good grounds that discretionary expense is worth allocating some funds to. And then it becomes a matter of whether or not that's the highest priority. So you can list out all your discretionary expenses that you're looking to allocate funds to, and you can say, okay, this one is the most important. And that can be a little subjective, but it's a good way to have a thought-provoking discussion. Make sure all of your goals, or make sure you consider all of your goals when setting your budget. And then another exercise that you guys can take, I found this fairly helpful for some financial planning clients, is you can actually print off your bank statements, and you can block out all the dollar amounts, because oftentimes the dollar amounts can create a bias with people. If they see, oh, this was X amount of dollars, we don't need that, we can cut that. So block out all the dollar amounts so you don't have any bias there, and then go over each line item and discuss whether or not this is a truly enriching expense, or if it's just something that we could live without, that we're just throwing money at that we don't necessarily need. So that's another exercise that I would certainly recommend. And the next section, so this will be number 3 on your guys' list, is the emergency fund. And so I know Bryce touched a little bit on the emergency fund last week, so I won't go into a lot of detail. And then, like I said, Nick and his wife will be covering this, it sounds like, in greater detail on the upcoming Financial Peace University courses. But generally, a $1,000 emergency fund can be sufficient if you're making a strong effort to aggressively pay down your debts. Once your more pressing debts have been paid off, having 3 to 6 months worth of living expenses could be something to aim for. You may be wondering where you can actually put your emergency funds besides the savings or checking account. So this one that covered last week, but there's a host of avenues that could work a lot better than just a savings or a checking account to hold your emergency funds. One is certificate of deposits. A lot of people don't realize that with a certificate of deposit, even though you technically lock into like a period of time where you're supposed to keep the money like locked up, essentially, a lot of times the banks have a fairly lax policy on getting out of a CD. So I know when I worked at the credit union previously, if you got out of a CD, they would just hold out the prior 2 months worth of interest that was accumulated by that CD. And so, I mean, if you guys have had CDs, 2 months worth of interest can be a pretty minimal amount. So if you have a CD where you have another opportunity come up, or you have an emergency to come up, you can access those funds. Those funds are not locked up so tight that you couldn't get to them. So that's one thing to keep in mind. A taxable brokerage account, that is, my wife and I use that for a lot of our emergency funds and actually our living expenses too. I'll cover that in quite a bit of detail later on in the presentation. Then we have the Roth IRAs, which we actually use that to fund our first home purchase. Anything that you contribute to a Roth IRA, because it's after-tax dollars, you can take out at any time for any reason without penalty, because you've already been taxed on it. You can't touch the gains. If you touch the gains, you're going to have all sorts of challenges come your way from a tax perspective. But as far as the contributions go, you can withdraw those anytime for any reason. And then I'll cover a little more about all those types of accounts a little later. But that covers most of what I had for emergency funds. Like I said, Bryce touched on that last week, so if you guys want a refresher course on that, feel free to view the YouTube video there. Fourth, we're looking at managing debt wisely, and again, this was another thing that Bryce had covered last week for a bit, but generally, debt on a depreciating asset is a bad idea. Like people, if you buy a car that, I mean, sometimes you kind of have, if you really need a car, you might be forced into buying one essentially. But I mean, I personally have never owned a new car. I probably will never own a new car, just because they lose so much in depreciation over the first three to 5 years. So just keep in mind when you're taking out debt, using it to buy a, using it to buy a heavily depreciating asset is usually not the most prudent way to allocate debt. Generally, debt can be a helpful tool if used appropriately, though. As far as some appropriate uses of debt, buying a home is certainly one. Although with interest rates increasing more and more, it's becoming a little more expensive and costly for people. I mean, we're finding that with the church, with the parish. Interest rates are going up and up, and it's becoming more and more expensive to carry that debt. And so the same concept for real estate applies there. You can also use debt as far as using debt wisely goes. You can use debt to purchase rental property. Again, this is the higher interest rate environments are a little more challenging when it comes to purchasing rental property. But rental property is an interesting one because it has so many different strategies for minimizing your taxes. There's something called bonus depreciation, which you can actually get what is called a cost segregation study. And so say you buy a rental property for like $200,000, and that rental property is about $170,000 is placed into the building of that rental property, the value, and the remaining $30,000 is allocated to the land value. You can't depreciate real property, so land, but you can depreciate everything associated with the building. So what you can do is you can run what is called a cost segregation study to pull out all the depreciation or the depreciable assets associated with the building itself and front load the depreciation. Right now they have something called bonus depreciation. So any asset that is deemed to have a useful life of less than 20 years, you can depreciate up to, this year it's 80% of that total depreciable amount. So if you determine that the depreciable value of all the assets with a useful life of less than 20 years is say $100,000, you can deduct $80,000 in that first year through bonus depreciation. So if you have any other passive income anywhere, you can use those passive losses to offset from that depreciation. You can use those passive losses to offset that income. And then anything that's unused of those passive losses is carried forward into future years. So if you have rental income coming in, that's a passive gain. That can be offset by the passive losses. So you run into a situation where if you find a good deal on a piece of rental property and you do run a cost segregation study and you depreciate it out, you run into a situation where you could have 5 years or so worth of rental income where you pay no taxes on it because you're front loading that depreciation and you're taking advantage of that benefit. So, yes, Brian?
So how long do you have to keep the asset for that to?
So
'Cause I know if you sold it in between, you would.
Yeah, so that's a good question. So generally, if you can sell the asset at any point in time. What will happen is any amount that you recognized as depreciation will be recaptured. So you'll be on the hook for paying ordinary income tax on that depreciation recapture. There are some ways around it. Like for example, if you hold onto the asset until you pass away, your children, depends on how the asset's being held. You can hold a piece of rental property in an LLC, taxes like an S corporation, which I wouldn't recommend, or like a disregarded entity. But that's a little more in depth than what we're dealing with. But to answer your question, Bryce, you can sell it whenever, but you will have depreciation recapture unless you pass away holding the asset. Then you will have no depreciation recapture. It'll just step up in basis, and your kids will actually be able to reset or whomever inherits it will be able to have a reset of depreciation, and then they can actually start taking depreciation expenses on it. And then the other option, let's see, well, would be to gift it. Gifting it, you would have no depreciation recapture. And then, let's see.
We've got the option if you sell it and then buy another piece of rental property you can sort of avoid some of those headaches.
Yep.
By putting the money back into another piece of
Yep.
real estate.
So yeah, Deacon brings up a great point. So you can do a 1031 exchange. So if you sell that property, you have, I believe it's 40 days, might be 60, I believe it's 40, to identify a handful of new target properties. So you could say, oh, I just sold this asset. There's 6 properties that I'm looking at potentially investing in. You identify the properties, the potential investments within 40 days, and then you have like 180 days, I believe. Don't quote me on that because I think it's around there, but you have 180 days to close on that new property. And then what would happen is you would have an adjusted basis. So if you say you depreciated out $100,000 of a $200,000 property and you did a 1031 exchange, your basis in that new property would then be $100,000 lower than it was. So it's almost like you're taking depreciation right off the bat of that new 1031 property. So then when you go to sell that 1031 property, then you would be hit with the full depreciation recapture. So yeah, if you guys want to talk more about that, my brother's in developing real estate, so I could talk about that stuff all day. So, all right, we'll move on here. Oh, and other real estate. So as far as if you're like a developer goes, and you're buying a piece of land and putting a home on it and then selling it, that can be a fairly prudent way to invest using debt. And then funding and education. If you want to be a doctor, if you feel called to help people through that profession, taking out a loan to be able to pay for the schooling, to be able to get that qualification, certainly not a bad idea. I will say though, be prudent on doing that, especially in high interest rate environments, and also be prudent on what you want to pursue. Because if you are taking out a bunch of debt to pursue a degree in like history, where all you can really do is teach history, first of all, the job prospects aren't great with that, and secondly, they're usually not very high paying. So if you're taking out loads and loads of debt to fund this aspiration, I would strongly consider the financial burden that's going to create. So just one factor in paying for education, but generally education can be a good investment as long as you have a good solid plan and the job you're ultimately going for provides a solid or an adequate salary or wage prospect. Let's see. Utilizing debt is a tool for any investment. So you can take out loans against like stock or bonds. That's generally not ideal unless you really know what you're doing and you're really careful. It becomes much less practical. All of these actually become much less practical in a high interest rate environment, which we're seeing that now as the Federal Reserve tries to fight inflation and keeps hiking rate after rate after rate. Mortgages are becoming much more expensive. Everything's becoming much more expensive. So a lot of leveraging debt, a lot of those strategies, you have to just be much more careful with and really do your due diligence before jumping in, because it can lead to disaster if you're not really careful. Okay, the next is automating savings. That's point number 5. Father touched on tithing during his presentation in the first week of Godly Finances, so I encourage you to visit the St. James YouTube channel if you haven't seen that one yet. He did a great job on that. There are many different ways that you can automate your tithing if that's something you're interested in. As for your savings, I'll cover some of the common accounts that you can use to actually hold your savings. HSAs, which stands for health savings accounts, are a phenomenal tool if you have a high deductible health plan. There's something called the shoebox rule for HSAs, and what that is essentially you can if you hold on to every receipt you get for any medical expenses you get, as long as your HSA was open prior to receiving that medical expense or that medical treatment, it is eligible for reimbursement. And what's nifty about the HSA shoebox rule is you can go many years in advance and just hold on to that receipt. And all of a sudden you could say, okay, I want to use this receipt and reimburse and take from my HSA, and it's going to all be tax-free because it's a qualified medical expense. So going in, you got a tax deduction, and taking the money out, you got it out tax-free from an HSA. So they're kind of that double benefit. And what's nice about it is you can do this strategically. So in a way, you can use your HSA as an emergency fund. So say over the years you accumulate a bunch of different medical expenses and you hold on to all of them, and you say you have your refrigerator breakdown or your car breakdown, you can all of a sudden cash in essentially on all of those medical expenses and take a large reimbursement from your HSA that's untaxed to cover all of those those expenses, the emergency expenses. So there's one way to use it, and you can use it, you kind of use your imagination there. You can use it pretty much any way you could think of for a reimbursed expense.
Shoebox rule apply to all HSAs, including the federal?
I believe so, because generally HSAs follow the same tax structure, unless it's like a flexible spending account. There's some caveats to that. I'd be curious to see what the plan document said about it in particular, because generally I'd say yes, but I don't want to give you an answer if the plan documents have something slightly different. So feel free. I'm happy to look at the plan documents if you have those. So, okay. So as far as what you can actually contribute to an HSA. You can do $8,300 annually for a family deduction, and then after you're age 55 or older, you can actually do an additional $1,000 benefit, and then individually just cut that number in half, the $8,300, and that's what you can do as an annual contribution. So if you have a high deductible health plan, HSAs are pretty awesome, so I highly recommend that. And then we have taxable brokerage accounts, and I mentioned that a little bit earlier. I'm a huge fan of taxable brokerage accounts, mostly because of their flexibility, and I'll compare and contrast some of the differences of a taxable brokerage account versus like a 401k or traditional IRA or Roth IRA. The taxable brokerage account, just in summary, you have long-term capital gains or qualified dividends. If you hold the assets in the account for more than a year, you have both of those qualifications. You also receive a step-up in basis. So like real estate, if you pass away holding the assets in a taxable brokerage account, the charity that inherits it or your heirs would all receive a step-up in basis of the value of the holdings in that account. And then you could also participate in tax loss harvesting. So much like I mentioned with the depreciation example with rental properties, where you can utilize that loss to offset certain gains, you can do the same thing with your investments in your taxable brokerage account. Say you're sitting on a large loss, say you bought Apple at the wrong time and you go to sell Apple and you're sitting on a large loss, you can actually use that loss to offset actually up to $3,000 of your ordinary income, and then beyond that you can offset passive gains. Let's see, and then we have, I'll illustrate that real quick. So as far as a taxable brokerage account goes, you kind of pay taxes as you go. So like if we were doing a chart of a taxable brokerage account, the savings might look something like this, and you hit with taxes because you get a dividend or you take some money out, hit with taxes, versus like a Roth IRA. So this is we'll call it a taxable brokerage account. So you have kind of a jagged line there, but with a Roth IRA, you're taxed on everything you put in. That's after-tax money that you can put into a Roth IRA. But the Roth IRA just grows essentially tax-free indefinitely, unless you take out your principal contributions. But assuming you don't take out your principal contributions, your tax grows tax-free, and then when you make the withdrawals, it will just decrease gradually as you make the withdrawals. Versus a traditional IRA, where I'm running out of space, writing too big. I'll get rid of this guy here.
You could push it down and another.
Oh, okay. Well.
Just push down. Yep.
Oh, wow. That's nifty. Okay. Okay. So then we have just a regular traditional IRA, or like a 401k would fall under this logic, or a SEP IRA or simple IRA. All of them follow the same tax structure, where you get a deduction for everything you put into the account, and then it grows tax deferred. So you may be able to hypothetically put more money in because you're saving on a tax bill, because your taxable income is reduced by the amount you put in. But so what happens is your money grows and grows and grows, and when you start taking money out, you're hit with ordinary income tax rates. So you might see a kind of a cliff at that point. There's no tax advantage to an IRA, SEP IRA, 401k, any of that stuff. There's no potential tax advantages to having those accounts. It's one reason why I'm not a huge fan of them, and I'll talk a little bit about overfunding 401ks a little later. But with like a taxable brokerage account, which I got rid of for you guys, you can at least take advantage of qualified dividends and long-term capital gains, which those both have favorable tax rates. If you make less than, I have the number somewhere here, it's like $89,000 a year taxable income. you're taxed at 0% on all long-term capital gains and all qualified dividends. If you make from 89,000 all the way up to like 550,000, you're taxed at 15%, and from about 550,000 on above, you're taxed at 20%. So the highest you can possibly tax with a taxable brokerage account, subject to long-term capital gains, and remember, holding the assets in the account for more than a year qualifies you for the long-term capital gains and qualified dividend status. The highest you can be taxed is 20% versus ordinary income tax, which the highest marginal tax rate in the US currently is 37%. So you have a big differentiation there. Now, let's see. Oh, and then we have, oh, sorry, Father.
I just was going to ask about the IRA. I think Zach, when he was talking about this a little bit, he said that you can pull money out of your IRA to make like a charitable contribution, and then you wouldn't pay the taxes. Is that correct?
Yeah, that is correct. So that's an excellent point, because if your goal for 401k funds or IRA funds is ultimately to give, which I actually, when I was working at the credit union, we had a lot of situations where the clients would do all this planning and accumulate, and when they got to retirement, they realized they really saved a lot more than they really needed. And so it was a perfect situation for them to do what Father was alluding to, do something called a qualified charitable distribution, a QCD, which takes any of your any of this, and it allows you to give it to a charity. So like say you were giving it to St. James, and you would pay no taxes on it. So it's a way for you to essentially get the tax benefit up front when you put the money in, and then you can minimize the taxation coming out if you give it to a charity.
Question: when you do that, is that, while it's not taxed, is it still listed in your deductibles if you are at the point where you can itemize?
So
let's say I get $10,000 as my distribution.
yeah,
I give it all to St. James.
yes.
Do I get a $10,000 itemized item, or is it just I don't get taxed on it?
So yes,
Neutral?
that's an excellent question. So generally, when you give, you would only necessarily take advantage of that gift, that charitable donation, if you were to itemize deductions. In the instance of a qualified charitable distribution, however, that would only be recognized on the withdrawal side of the IRA itself. So instead of reporting any giving on your return, you would just simply report a qualified charitable distribution, and you would not report that as income. So to answer your question,
I could list it as my itemized deduction.
So it would not show up on your itemized deductions, because it's being taken out at the account level.
You can't double dip it.
Yeah, so you can't take the deduction.
Checking.
Yeah, so you it's tax deferred income.
So another option you can do is you can give out of your IRA instead of giving out of your ordinary income,
Yes.
and then you can then not have to pay any of the taxes on
I'm
it.
just
You don't
trying to figure
itemize
out how
it.
to
You
work
just
the itemization, because I itemize stuff.
Sure. And yeah, the right now the standard deduction is like 24,500, something like that. It's really high because of the Trump tax cuts in 2017. So a lot of people don't itemize, but like Bryce was saying, instead of giving from your ordinary income, if you're retirement age and you're wanting to give, I strongly encourage you to give directly out of your IRA, because you're going to be money ahead by doing that, unless you're itemizing every year and maybe you have a bunch of interests that and medical expenses that are going towards the itemization. But generally, giving out of a tax-deferred account, so SEP IRA, Simple IRA, 401k, traditional IRA, is a better alternative to giving directly from your income. Okay, so that covers that. Let's see. And then now we can talk about a little bit about investing for growth. I'll talk about the different investment choices. I'll just leave this up here, actually. We have exchange-traded funds and mutual funds. So that's essentially like a basket of different stocks and bonds, or a combination of the two. Exchange-traded funds have some benefits because you have a little more control over when you recognize the gains. Dividends are going to be paid no matter what, but like capital gains with a mutual fund, you're going to just receive capital distributions, so you're kind of at the mercy of the fund manager. With an exchange-traded fund, it's treated similarly to like a stock. So you only recognize the gains when you actually sell on a exchange traded fund. So in some ways, you can argue that an exchange traded fund is more tax efficient than a mutual fund. And then on the other hand, generally exchange traded funds have lower costs associated with maintaining them than mutual funds. So I tend to favor exchange traded funds for those two reasons. But I mean, there's certainly some good mutual funds out there as well. There's also just stocks, which is just a partial ownership in a company, which you can invest in. Some companies give dividends, some don't. And then you have bonds, which is just debt that you're essentially loaning a company money for a note, and they can promise to pay you either interest or they can promise to pay you like a premium on the due date of that debt. So either way, those are kind of the more traditional investments. There are other investments like things called structured notes and options. We won't cover those, but just know that they're out there. Then we have hybrid insurance products. Those exist, but suitability considerations are super important. Generally, I'm not a huge fan of them, but they're very complex, and generally there are pretty large commissions associated with the sale of these products. So just be very aware of the pitfalls of these. And if you're not sure of what you have, I know when I was at the credit union, we had a bunch of clients because I essentially inherited a book of business from the prior advisor, and that advisor had sold a lot of what is called variable annuities, and the clients had a very minimal understanding of what they actually had. And so I had to go through and do a lot of just personal education to teach them, hey, this is what you actually have. And for a lot of them, they said, well, I don't really want this. After they fully understood the concept behind what they were doing, the fees associated with the variable annuity, they didn't want the product. So if you're in a situation where you own one of those hybrid insurance products, please either do your due diligence to make sure that it's in alignment with what you want and you have a full understanding of what you have, or reach out to somebody like me or any professional that can give you some guidance on it. I think that's pretty important to cover. As far as savings goals, I won't cover this too much, but the power of compound interest. So if you earn 5% year after year after year, that can be a pretty powerful tool in accumulating wealth and reaching your goals. Because I mean, even if you donate or say you put in $100 each month over the course of say 40 years, and over that 40-year time period, you make say a 7% return on average over that 40-year period. You end up that 40 years with a pretty substantial amount of money, even though your contribution was say only $100 a month. So the power of compound interest is very important. And then we have asset allocation and risk tolerances. I won't cover those too much, but generally stocks tend to be a little more volatile than bonds, and you want to kind of create a portfolio that makes sense for your own personal preferences. So if you want something that moves more like a straight line like that, and less like that, then you're going to want probably a more bond-oriented portfolio. And as you get closer and closer to retirement, and you don't want to see those funds go up and down so much. I know some people have had to delay retirement because they get to retirement age and all of a sudden they're at a down market. Say people that wanted to retire in 2008 when we had the housing crisis, that was a tough blow for them because a lot of times they had to postpone retirement because all of a sudden their life savings went way, way down. So just consider those things as you go along. Generally, the greater risk you take, the higher potential for return, but also the higher potential for an actual loss. And also don't overthink your allocations. When I was, younger I'm pretty young already, but when I was even younger than I am now, I had a custodial investment account, and in that account, I would try to find the best stock out there, and this was a great learning lesson in life, and I would chase the returns, because occasionally you'd have a couple excellent days of returns where you'd generate maybe 5% in a day, just a really good swing on a stock. But I learned the hard way that it can very quickly get erased if you make some mistakes. And so fortunately, I was dealing with a lot smaller sum of money, but it was a wonderful life lesson because it taught me that for the most part, trying to chase like percentage points as far as rate of return goes is not going to be your friend. You're going to spend hours and hours, and you're going to take the losses really hard if you try to pick if you're an individual stock picker. even Warren Buffett makes mistakes, and he's a pretty good stock picker, but he had a slightly different situation growing up than we're in now. With the age of technology, we have so much information at our fingertips, and that can be a blessing, but it can also be a detriment, because if you get down a couple rabbit holes, you can spend hours and hours making some pretty costly mistakes. So generally, just a simple exchange-traded fund or mutual fund that maybe mirrors the S&P 500 can usually get the job done. And over the period of time of putting money in, just gradually or automated, so every month you're putting money in, you do something called dollar cost averaging. So when the market's down, you're buying. When the market's up, you're buying. You're just buying consistently. You're going to find that your rate of return looks a little more level, and ultimately you'll probably be in good shape by the end of it, and you don't have to worry about the stress and the pitfalls caused by individual stock investing. Let's see. Okay, and then we have reviewing and adjusting for life. That's point number 7 on the list. I just recommend when you go over your financial plan, writing it down. If you write down, I have actually on my website that I have for my accounting firm, I have an organizer that has basically a fact-finding sheet, and I encourage you guys to essentially print that out and go through it. And what it does, it allows you to list all of your assets that you own. And what I have found is if you document what you own, in most circumstances, whether that be working with different financial professionals or whether that be a situation where you pass away and your kids are like, what in the world do my parents have? They can pull up that document and say, okay, we have a list of everything. So it simplifies where you're going, because it's hard to know where you're going if you don't know exactly where you're starting. And so that's kind of the whole concept, is if you list out every account you own, you're going to be in good shape to be able to seek advice from others, and to also put your kids in a good spot to be able to be familiar with what you have.
Not just your kids, your widow or widower.
Exactly, yep.
Don't overlook that, because a couple of us here have dealt with people in that situation.
Oh, yeah.
The lack of ignorance is potentially life-threatening.
Oh, yeah. No, I agree. That's a good point. And with that being said, speaking of losing accounts, I know like I said, when I was working with the credit union, I had quite a few children who came up to me and I'd say, hey, your parents had this 401k over here with Schwab. And they're like, oh, we had no idea they even had that. And it happened quite a bit, more often than it should, where there was an account that the children or whomever inherited these monies had. There was an account that they were completely unaware of. And so having something that documents all of it will be very, very helpful, because if an account is left unclaimed for a period, I think it's like 2 years, then it just goes to the federal government. And I mean, they'll happily take that fund money. They're not going to argue with you. They're not going to try to seek out the owner. And so it's up to all of us to do the due diligence to make sure that whoever receives the inheritance is familiar with what we have. Because if you don't do that, you might have your account might be going to the government. So, yep.
In fact, for those of us who are retired annually, we should provide an update to our kids of all of that information.
Absolutely. No, I agree. I think at a minimum, reviewing your financial plan and reviewing all of your holdings is a prudent idea.
Even with a savings account, you've got a savings account and you don't touch it for a couple of years, they're going to deem it closed.
Yep, they'll deem it as abandoned. So
Yeah,
any account you own, and when you pass away, that is unclaimed for about a 2-year period. I'd have to double check on that, but I believe it's a 2-year period.
At least 2 years.
Okay. After a 2-year period, the state or the federal government comes in and says, oh, it's our money now.
So you need to take a little out and just wait a little bit, put it back in again.
Yeah, and see that's or just file the beneficiary forms to claim the account. Yep. So one reason or another, or one way or another. So now this is the last section, number 8. We'll be diving into the details. This was the most fun section for me to write, just because it has the most tax strategy. And for some weird reason, I really like learning about tax strategies. Just it's something fun for me. The idea of tip your server, not the IRS, rings true to me. If you can essentially save, if you can find a creative way to save on taxes, legally. We're not going to encourage any illegal activity, but legally save on taxes. I want to try to find any potential benefit that we can have to save on taxes. So some of that, as far as the tax code and how it's written currently, there's a ton of advantages for business owners. For all of you guys that own your own business or have owned your own business, if you're sole proprietorship, you have the Schedule C, which you can deduct. All of a sudden, if you're a business owner, you have all these expenses that were ordinary expenses for you that you can now deduct against your taxes. I mean, you can deduct through the home office deduction. You can deduct a portion of your interest that you do pay towards your mortgage, a portion of your utility bills. I mean, everything. There's a bunch of things that all of a sudden become deductible, like even your cell phone bill. And then furthermore, if you went the route of what is called an S corporation, I prefer the structure where you're an LLC taxed as an S corporation. An LLC in and of itself is not a business entity. You can elect to be an LLC taxed as a certain tax structure. So whether that be an S corporation, a C corporation, a sole proprietorship, which is called a disregarded entity in the event of an LLC, or a partnership. So any of those four. If you are either a partnership or a S corporation or a C corporation, you can do something called an accountable plan. And an accountable plan allows you to essentially deduct your entire cell phone bill, not just a portion that's attributable to business. And there's a whole host of other deductions that you can receive through an accountable plan through an S corporation. The list of tax benefits by using an S corporation is huge. An S corporation if done strategically and done correctly, it can yield more tax benefits than almost any other business entity can. The other thing to consider is the Augusta rule. For those of you that aren't familiar with that, there's the Masters was held in Augusta, Georgia, I believe. And when that happened, the residents of the state of Georgia wanted to rent out their house for a period of time. And they said, well, we're only renting our house out for 2 weeks. Like, why do we have to report income for a rental that was only 2 weeks? It's not our primary income, it's just a supplement. And we're providing additional housing for an event that floods the city and clogs up all the hotels. So as a way to essentially encourage people to rent out their homes so that there's not a financial or economic strain, and it's better for Augusta, Georgia, because then they're able to bring more people in and more income comes to that town. But essentially what the IRS said is if you rent your home out for a period of 14 days or less, none of that income that you receive for that rental is taxable. And so you essentially are generating tax-free income for 14 days. Now, you can't do some outrageous rental amounts. You can't say, I'm going to charge $1,000 a day for 14 days, but you can do maybe $200 a day, $200 a night for 14 days. That's perfectly reasonable to do. But furthermore, if you want to get into a little more tax strategy, tax planning, if you own an S corporation, you can actually rent your primary residence from yourself through the S corporation and write off that S corporation as an expense. Now, it has to be a legitimate reason for renting the property. So like you could host, say you have a couple employees and you want to do like an employee appreciation retreat, something at your own home, or host an employee seminar or dinner, or a couple employee seminars and dinners. It has to be a legitimate business reason. But if you do that, you can essentially pay yourself through an S corporation, take a deduction on the S corporation side, and recognize no income on the personal side. So it's a way to take a deduction without really changing anything. That's the Augusta rule, also known as Section 280A of the IRS code. Feel free to ask me about that if you have more questions on after this.
Does that apply to free spirit?
We're tax exempt.
Yeah, that nonprofit wouldn't qualify, but
I thought maybe you could use it to bring back the picnic.
You can use it to bring back the picnic. Somehow we can rent your house with a picnic. I bet we can pull it off.
Remember the fireworks?
Oh, no, Ryan, and the fireworks. The fireworks could be, we could do it, and then I bet if you talk to Cody, we could get a tax write-off, and Carol might start to love the fireworks.
yeah, well, work with me on it.
What makes you think that I'm not doing that?
Well, it's not benefiting us.
I'm not looking to benefit you.
Yeah, let's work to make the whole thing tax deductible. So. All right, so where were we?
I tried.
Going around, going on.
The Augusta rule, as I mentioned, it can work with an S corporation, a C corporation, or a partnership. Either one of those three will work. If you're a disregarded entity or a sole proprietorship, you can't do it. It's going to raise all sorts of red flags. The IRS will disallow that. Let's see. Oh, and then also hiring your kids. So this is something that I intend to do with Rose. She already likes to help me quite a bit with work when she can. But at some point when she is old enough, if she has the interest, I'm not going to force her to. But
Cookies tonight. Can we write that off?
yeah, see, yep, we absolutely could do that. But with hiring children through your business, you can do it whether you're a disregarded entity, S corp, LLC, any of that stuff, a partnership. You can hire your children, and you can pay them. I believe it's up to $12,950 annually, which is the standard deduction. You can pay them that amount, and they will be subject to no taxes. If you do it as a W-2 employee, they won't pay any taxes on any of it. If you do it as a 1099 employee, they would actually be subject to self-employment taxes. So I would not recommend doing it as a 1099 employee for that reason. But if you pay your children, they have to be doing like a legitimate business task. So whether it be like bookkeeping, I could have Rose enter in some reconciliation statements when she gets that age. I don't know if she can do that right now, but I could have her do that, or I could have her clean up the office, but it has to be an actual like reasonable business expense to be able to utilize that. But the way I see it is it's a great way to encourage your kids to start working early. It teaches them a little bit about taxes. It teaches them what it's like to have income. You can use that money to fund a Roth IRA, and they can learn about what it's like to start their first retirement account. So there's a lot of different layers of learning associated with hiring your own children. And then there's the obvious tax benefit from a business side, because if you pay your kids $12,950 every year, you can deduct that as a business expense. So a lot of benefits to be had there, and then you can also technically help fund their college education that way as well. And through a Roth account, we're kind of getting into the weeds here. A Roth account, anything that they contribute to it, they can withdraw at any time for any reason. So if they decide all of a sudden that they want to utilize the funds in their Roth account to pay for an education, or do what I did and use their Roth savings to pay for their first house, they can do that. There's so much flexibility in that. So for all the business owners out there, paying your kids is just a wonderful opportunity all around. Now, let's see. I talked a little bit about this earlier on the benefits of investing in like ETF stocks and bonds for step up in basis at the time of passing. So say you were to buy like Apple stock for $100, and then all of a sudden it appreciates to $1,000 over the course of 20 or 30 years, and you pass away. The value of that stock the basis for your children would be the value of that stock at the date of your passing. So if Apple stock was sitting at $2,000 at the date of my death, and my children receive it, they would have a basis of $2,000. So if they go to sell it, they'd pay no taxes on that income or on that sale. The same goes to charitable distribution. So if you have highly appreciated stock in your taxable brokerage account, you can give that to a charity, and you're not going to pay any taxes on it. It's just going to basically erase that potential tax bill. So for people that are, say they're compensated with ownership in the company, so people that are like Apple employees that get stock-based compensation, and over the years of working for Apple, they've accumulated all this stock-based compensation that's appreciated to huge levels, and they're at a situation where they don't really need the funds. That's a great opportunity to give to any charity for that matter, St. James, whatever it might be. And then that's a situation where you can use your appreciated stock to front load your giving, and then you can meet that itemized deduction requirement and take advantage of the full tax benefit. And then, as far as asset management goes, I did a lot of that for clients. That's what I did for probably most of my working career, is managing other people's money. And I've kind of come to the conclusion where that's becoming less and less of a value add and more of a commodity for people because of the information that we have today. If you have a little bit of kind of do-it-yourself spirit and want to kind of dive into it, you can learn how to do your own investing and save yourself, 1 to 2% fee every year for the rest of your life, which if you're really young, say you're in your 20s, and you start investing, a 1% fee of over a 40-year period can be a huge amount of money. So I strongly encourage, especially for young people that have a lifetime worth of saving and accumulation, to try to learn to invest themselves. If they want some guidance, I would love to share that with them. I was blessed to have the opportunity to start investing when I was very, very young. I think I was like 12 or 13 through a custodial account, and it taught me a lot of very valuable lessons, and it gave me a very good money sense. And so I hope, I would love to be able to have the opportunity to share that with others and encourage other young people that they don't necessarily need to use a financial advisor to be able to make prudent investment decisions.
Question.
Yeah.
When you make that recommendation, how many hours per day or per week does an individual have to be committed to dedicating to manage that situation? So
that's a great question. So the easy answer there is kind of a cop-out. It depends. It depends on how far you want to go into it. I did a lot of dabbling with individual stock investing early on. I did it early on in my career, early on in my youth, and I've come to the conclusion that for the most part, unless I'm actually going to sit down and read company 10K reports and really dive into the weeds of it and understand look over there and know every line item on their financial statements, it's just not worth the time. You're going to have some level of guessing involved in individual stock picking. So for the average person, I would recommend not doing any sort of individual stock picking. But to answer your question, if they're sticking with just general broad market exchange traded funds, mutual funds, keeping it simple, you really would not have to allocate a lot of time. You can automate your savings so that the funds that come in go directly into an account that's allocated based on your preferences. And you do a little bit of work up front. You do all the tasks of actually opening and funding the account. But then once that's set up and you have a good plan in place, it really won't take probably an hour a week, maybe, is what you'll...
How does that then work for those of us who have work-related 401ks where we have choices of investment, and the fact of the matter is most Americans don't bother to monitor that. Therefore, they're losing and gaining unconsciously.
Yeah, so
you're not dedicating the time required.
Yes, so that's pretty common. It's they're pretty simple. So with a 401k, there's usually only about 10 to 30 different funds that you can choose from within that 401k. And so usually they lay them out pretty well where you can do like a growth-oriented fund or a balanced fund or a conservative fund. It's usually labeled pretty well, but like you mentioned, most people just set it right when they start contributing to the 401k, and then they don't worry about it for the foreseeable future. For people that haven't looked at their 401k funds in a really long time, I strongly encourage you to take a look at it, look at your statement, look at the list of funds that are available. And if you don't want to go through and try to identify which funds might work for you, reach out to somebody like me. I've had a lot of experience with different mutual funds and ETFs, and I'm pretty familiar with who the good ones are, the bad ones are, and the fees associated with it, because those are probably the two biggest factors, is the holdings within the fund and then the fees associated with the fund. But if you look at those two things, you can pretty quickly identify what funds make sense, and generally, for the average person, the closer you get to retirement, the more you should be in a fund that's more bond-oriented, and the further away from retirement, the more you should probably be in a fund that's more stock and equity oriented. But to answer your question again, I'd say if you don't want to put in the due diligence and the work to try to figure out what funds make the most sense for your situation, feel free to reach out to somebody like me or really anybody that is in the career of advising others with their assets. And for the most part, some financial advisors won't talk to you, or financial planners won't talk to you unless you're working with them. But there's a lot out there that genuinely want to help. And so for the most part, you could probably get a lot of that information at no cost. There's some platforms that allow the financial advisor or the financial planner to actually manage the 401k on your behalf. So they can log into a portal where they see all of your savings and they can actually choose the funds for you. But usually that comes at a fee, and that fee can be fairly substantial. So just kind of weigh the pros and cons. I'm certainly saying don't ever do that and have a professional do it for you, but just be mindful that a little bit of effort on your side might be a pretty substantial payout on the latter end.
And for those who are federal employees, they need to be aware that they can only invest in certain things given jobs and responsibilities relative to the filings that are required.
Yep. So that's correct. So and with federal employees, depending on how the plan documents are written for that federal savings account or federal retirement account, a lot of times federal employees who retire will be eligible to roll over the funds into like a traditional IRA, and from there you can invest in with a lot larger scope of investments, because instead of being limited to maybe 10 to 30 different funds, you now have, I mean, there's over 4,000 funds on the U.S. stock exchanges. So so you have a lot more variety. So that's what I would encourage. If your plan allows it, rolling over the funds to a traditional IRA would allow you a lot more flexibility. But if you're used to your plan and you're familiar with the funds in your plan and it's worked well for you, there's certainly no harm in keeping it in that employer 401k plan or a federally sponsored government plan. Okay, let's see. Oh, I wrote some numbers here just as a hypothetical. If you were to start contributing to a traditional IRA, say you started with $500 and you contributed $500, or not $500, oh yeah, actually $500 a month, every month for 20 years, and say you were paying somebody to manage your money, a 1.5% fee over that same period of time, that fee would come out to, over that course of the 20-year period, would come out to $30,478. So you have to ask yourself, is it worth a little over $30,000 for that money manager to manage my money for me, or would I rather put in a little bit of work and do the due diligence and save that $30,000 on the front end? So, and there are other considerations, because oftentimes people let their emotions get in the way of making prudent financial decisions, especially when it comes to investing. So sometimes a financial planner or asset manager or financial advisor can save you by hopefully minimizing those irrational or emotional decisions. So it really depends on your situation. If you're a strong do-it-yourselfer and you're disciplined, investing yourself might make a lot of sense. But if you're just thinking, oh, I'm pretty emotional when it comes to this stuff, I really don't want to put in the time to do this, then certainly using a financial professional could work out for you.
You would need to consider that the $30,000 you just mentioned would have to be offset by what returns you got on that $6,000 a year for those 40 years. Because if they give you a 5 or 6% return, you're actually paying for their confidence.
Yeah. Oh, yeah. See, and that's the thing with a traditional IRA. You're also, that's all tax deferred money. So another way to look at it is you're compensating the advisor on money that doesn't even belong to you, because the IRS technically has a claim on, say, 20%. If your tax rate's 20% of those proceeds. So if you have a $100,000 account, really only $80,000 of that is yours, but yet you're paying a fee to have those funds managed on that full $100,000. So there's another consideration. I think that was kind of beside the point of what you touched on.
You know, it touches on it.
Oh.
I'm at the age where I have an RMD.
Oh, yeah.
And as long as my corpus is larger after 6 years of withdrawals, we're doing a good job for me.
Oh, yeah. Yeah, no, that makes sense. One, with the RMD is an interesting one, because I had quite a few clients previously that had RMDs, and that was a perfect opportunity for them to do a qualified charitable distribution to satisfy the RMD, because they had other income coming in from other sources like Social Security, so their needs were being met. And so instead of giving through Social Security, where they're going to be subject to the itemized deduction limitations, they could give directly from their RMD, their retirement account, and minimize the tax burden there. So just a little bit of strategic planning there can.
And it minimizes their payment on Part B of Social Security, because that's partially driven by income.
Yep, absolutely. Okay, so and then the last one, overfunding your 401k, is probably isn't the best. So first of all, take advantage of the match on a 401k. So if your employer will match 5%, by all means, put in 5%, because if you aren't, you're leaving money on the table. Because even if you're taxed, you're deferring that income. Say you're taxed at 40% even. You have dollar for dollar more. 60% of something is a lot more than 0% of nothing, essentially. So the way I see it is, if your employer does a dollar for dollar match on your 401k, take advantage of that full match. But I tend to not favor any sort of contribution above the match, mostly because, as I mentioned earlier, it becomes fairly tax inefficient. You're locked into ordinary income tax rates, and you're subject to RMDs, as he mentioned a little bit ago. So it makes planning for retirement a little more challenging, because we're in the age of 401k millionaires. We have more 401k millionaires than ever before currently. And it's a little tricky to plan if you have a 401k, because if you're a 401k millionaire, you're going to expect to pay anywhere between 10 and 30% in taxes on that 401k. So if you have $1 million saved up, it looks more like maybe $600,000 to $800,000. So you're already starting off with a much less than you had anticipated for. And so I'm not a huge fan of that from a tax planning perspective, but ultimately if your goal is to gift from that, then that could work out really favorable. So essentially I'm not a big fan of over-contributing to a 401k unless there is like a large cliff taxes that you're avoiding. So I know Zach touched a little bit on cliff taxes on week 1. Cliff taxes are things like, I had a list here. Like Medicare, net investment income tax, estate taxes, different state and local taxes. Basically, there's these taxes that if you make a dollar more additional amount of income, all of a sudden you're being taxed heavily on whether it be like Medicare related expenses, but you're being hit with a tax that you didn't previously have. And it's not like a marginal tax rate where you're only taxed on the portion that's above a certain amount. You're taxed on the entire amount. So that's why they call them cliff taxes. It's not marginal, it's the full amount. So as soon as you cross this threshold, you're essentially penalized on the full amount. So if you can avoid cliff taxes by contributing a little bit extra to your 401k, although like I said, it's not necessarily ideal, it can still be prudent and worth it if it's avoiding a significant cliff tax. Yeah.
If there are people in this room who will have a fixed, besides Social Security, will have a fixed pension of some sort.
Okay.
If their only source of retirement income, other than Social Security, is going to be their 401k, would your advice still be the same?
So if they're...
Because right now, for example, for my kids, no retirement, 401k is going to be, plus Social Security, if it exists, is going to be their only source of income, generally, if you think of it as retirement. So is that the same advice? So
I'd say, again, the answer there is it depends, because if they can meet their living expenses with, say, just a Social Security income, I mean, ideally, if we're able to meet our living expenses with reoccurring income sources, that's kind of the ideal, where we don't have to worry about dipping into the savings, the funds that are not replenishable or easily replenishable. That's the ideal. So if you have, say, rental income coming in from a property you own paired with Social Security that meets all of your living expenses, and then over here you have a large 401k account that you're not going to do anything with, that's kind of the ideal situation. But in the situation where you have a shortfall, so say your Social Security income is not enough to be able to meet your basic needs of living and maybe some important discretionary expenses, then that would be a situation where doing strategic withdrawals from your 401k is a good idea. It makes sense.
So you need to make it larger in order to be able to do that.
Well, Cody, I think what you're saying from talking to you before is so if a company has a match, you would give up to that match.
Yes.
And then rather than keep throwing money in an IRA, if you had, say, $6,000 more, you would definitely throw it into a Roth so that you're paying the tax now. So you still have a retirement account that's already been completely taxed.
Yes. Yeah. So
that's what he's saying.
Yeah. So just to clarify on that, and thanks, Deacon. With those account types, and I actually should say, because we're getting in the weeds here, all of this definitely take as education, because I don't.
Wait a minute. I want to be real clear, and I'm not trying to be a yahoo about this.
Sure.
This is not a detail. These are people in our parish who are trying to figure out how to do just what we talked about.
Sure. And I'll
Okay, They don't have income, or their 401k because they were let go, and they're trying to figure out how to make that particular balance
Yeah.
work.
I
Sure.
think all Cody's trying to say is, we're going to, like when I get up at the end, we're not recommending that you go change your whole thing based upon our 1 hour class this
Oh, no.
evening.
Yeah.
You're gonna need
I
some
don't think
more
you are,
work.
but I think
Okay.
there's
So-
questions because the circumstances that we're talking about, most people don't have rental properties. Most people don't
Sure.
have those kind of things, and as a result, they're basically trying to figure out how to live in today's environment and be prepared for the future that is very uncertain, and for which they're gonna look at their 401k and maybe their social security, if they get it,
Sure.
as a basis for continuing whatever lifestyle they're choosing to live.
Sure.
So we can talk about the Roth thing that I just mentioned a minute.
Yeah. Oh, yeah.
I
Yeah.
understand what he's
Yeah.
saying, but that's
I think
part of the
everyone else
strategy.
Yeah. So I do have to say, just for like legal requirements, pretty much everything I'm saying take is like educational. Don't construe any of this as legal advice or financial advice or tax advice anyway, because I don't really want to get in trouble with any of the regulatory authorities. But generally, to answer your question, and just in general, so this is my personal experience. As far as kind of the order of operations for what I personally allocate funds towards is if you have a 401k match, allocate up to that match to start out. That would be priority number one. So if you are currently employed and you have an employer that's willing to do like a dollar for dollar match up to 5%, put in 5%. If you have, so beyond that, then contribute to a Roth IRA. Because as I mentioned earlier, there's all sorts of flexible advantages to a Roth IRA, and that income is tax-free and grows tax-free indefinitely, and you're not subject to RMDs, so nobody's going to say you must withdraw these funds. So the Roth IRA is probably my second preferred choice, and you can contribute up to $6,500 per year to a Roth IRA, and after age 50, I believe, you can contribute an additional $1,000, so $7,500 each year in total. And did you have a question?
What is a RMD?
Oh, so yeah, I'm sorry. So an RMD is is a required minimum distribution, and what it is, it was 70 years old for a long time. Now it's 72 years old. And what happens?
73.
No, not 73. My apologies. I should know that. But so now it's 73 years old, and what it is and why that rule is in place is for people that have pushed the tax liability out for such a long period of time. So everybody who has a Roth or a traditional IRA, a 401k, a SEP IRA, and they haven't paid any taxes on those funds. Essentially, the IRS said, we want people that have these funds and all this deferred income to pay taxes on all this money because we need our revenue. Because the IRS, our IRS always is always going to say they're going to need their revenue. So what they did is they said at a certain age, we're going to start essentially forcing you to make withdrawals on your tax deferred savings. And what happens is every year you go past age 73, the amount of that required minimum distribution increases, with the idea being after 10 or 20 years, most of that retirement savings has been withdrawn and the taxes have been paid. So in short, it's a way for the IRS to be able to get tax income, tax revenue on your IRA savings or your SEP savings or your 401k savings. So that's what the RMD is.
But the tax can be less than what would have been if you paid it in the beginning.
It can. So that's a big caveat. I know there's a lot of people out there that will try to sell either a Roth, the concept of a Roth, or the concept of a traditional IRA on the premise of trying to estimate what the tax rates might be in the future. I'd say that's just kind of a dangerous game to play because who knows where tax rates are going to go in the future. So I'd say plan like you have no idea where taxes are going to go in the future because ultimately we don't know where they're going to go. But
I guess I'm going to be doing a picnic.
yes.
How do you feel about life insurance? Whole life?
So that's a good question. So whole life insurance under very, very rare circumstances, it makes prudent sense. But I'd say for the vast majority of individuals, I'm not a huge fan of whole life insurance. That's my personal opinion. Again, not insurance advice, but my personal opinion is that I'm not a huge fan of life insurance. I'm especially not a huge fan of hybrid insurance products, as I mentioned earlier. Term life is excellent. I personally have term life on myself. I think that it's a great way to protect your income at a low cost. I like keeping insurance, and investments. I do not like combining them. When you get into the weeds of the whole life products, the variable annuities, you start combining aspects of insurance and you start combining aspects of investments. And usually what happens is you end up doing two things kind of mediocre. I'd rather do insurance over here and do that well, and do investments over here and do that well. Because with good planning, you're going to be a lot better off, in my opinion, than trying to get any of these hybrid products. So that was a good question, though. I figured somebody might bring that up, but.
What they say on that is if you paid $100, you could get the same life insurance, term life product for $15, and the rest would be $85 you can do an investment. It'd be better to put $15 in the term life and then $85 in your own investment, not $100 into a term life product.
Yeah. So generally, that's the idea, and that will probably work better for most people. But again, this is all in theory. So like I said, with all of this, do your own due diligence and do what you feel makes sense for your own personal situation, because all of us have different situations. But let's see. The next, we're wrapping up here. I'm not sure how I'm doing on time, but the next one I want to touch on was actually this last one. Second to last one, sorry. Seeking professional help. So what I've noticed in kind of all my different roles, because I've gone through the tax planning side or tax preparation side, bookkeeping side, insurance side, and the investment management side, I've seen kind of the gist of the industry in a lot of different areas. And I've come to the conclusion that a lot of times there's a lot of bias and a lot of disconnect between different financial professionals. So whomever you're working with, I strongly encourage you to encourage them to be working with the other professionals you use. Like your asset manager or financial planner or whomever it is or insurance agent should absolutely be discussing your situation with your CPA or your tax preparer. Like it makes zero sense to have all these professionals that are doing their own thing, and it puts you in a position where you're going to have tremendous bias and pull from all these different directions, because if the insurance guy is going to be incentivized to sell insurance products, so naturally that's how he gets paid, and so to support his family he's going to have an inherent bias to recommend an insurance solution, whether or not it might be or not be in your best interest. The same goes for somebody who's compensated through assets under management. So if they get a fee for managing your investments, their ultimate recommendations and an inherent bias, and you can't really blame them because that's how they make their livelihood and their living, is going to be to recommend something that is associated with investment management. And the same goes for the CPA, which it's a little bit of a different problem for the tax preparer and the CPA, is instead of making recommendations, they'll do your taxes, and they're in a position to add a huge amount of value from tax planning and certain recommendations around taxes. But they'll just do your taxes and they'll be done for the year. They'll do the bare minimum to make sure that you're compliant. They'll collect their paycheck and they'll kind of move on. So that's what I see a lot of times with accounting firms or tax prep firms is it's more quantity over quality. So I encourage you to basically challenge your tax preparer, challenge your insurance professional, challenge all of the professionals you work with to work with each other, because there's no need for, first of all, there's no need for you to share your financial situation with 4 or 5 different people when they could be discussing amongst themselves your situation you could share with one of them. So that's kind of my whole concept. And I think that's part of why I've bounced around to so many different financial professions. But ultimately, just be aware of the bias. So if you're working with only an insurance person that never talks to your accountant, your tax preparer, or an investment guy that does the same, or your tax preparer almost never recommends a tax saving strategy to you, or at least discusses, at least annually, your current situation and what your goals might be, I'd say challenge them to switch that up, encourage them to make a change, or maybe seek a different tax preparer, investment advisor, or insurance agent. That's kind of my 2 cents on that. The last one would be fraud, scams, and conflicts. So now more than ever, it's just crazy to me how many scams exist, and especially around cryptocurrencies. So there's a lot of buzz around cryptocurrencies, and I've noticed it's a huge target for scammers because people don't. It's pretty well unknown. A lot of people, many people, I'd say most people out there don't even know how to actually invest in actual Bitcoin, and so it's a great opportunity for people that know a lot about it to essentially scam other people who are unknowing or unfamiliar with the topic. So cryptocurrencies is one. I know the other one would be multi-level marketing schemes. Those are really common, and way more common than I would have ever guessed. I knew there's a handful of people that I used to work with that were participating in multi-level marketing schemes, and they're so good at these people that run these multi-level marketing schemes are so good at incentivizing other people to do certain things and to encourage them to bring their friends and their family members in on what they're doing, because it's just this wonderful opportunity that you'd be crazy to miss out on. And what I see happen is these multi-level marketing companies will give huge commission payouts for referrals to, the most recent one that I dealt with was a company that they're still going on. Their name is, I believe, Validus, and technically it hasn't been proven that they're an MLM that's scheming people out of money, but all the red flags are there. Yet there's some people that I know very well that are participating in this, and they refuse to get out of it because they're getting payouts from it. And what's happening is they're getting strong incentives to bring on their families and their friends into the scheme, and they're getting huge commission payouts to do so. And so they're making all this money, so life is good, so that's why they continue participating in it, and they're really buying into their message of, we're not selling investments, we're selling financial education. It's like, well, you're selling financial education only because you're getting a massive commission payout on the back end. And what's happening is they're taking from Harry to pay Sally, and eventually when that giant pool of money dries up, everybody loses. So there's a few at the top that are making huge amounts of money, and they're so encouraged by what they're making that they're bringing on a bunch of other people, and eventually the train will crash and everybody will come crashing down. So I'm seeing that a lot. And so you got to be careful with that type of stuff. If they're not like a registered with the Securities Exchange Commission, overseen by FINRA, or listed on the US stock exchange, even that you can get some pretty sketchy investment vehicles in. But if they're not in one of those, like if they're in an unregulated territory, this MLM company was based out of like Austria, and they had a headquarters in like, United Kingdom, something like that. But if they're an outsourced company and there's none of this like official registration, they're not overseen by any regulatory agencies, I'd steer far clear. It's a bummer because they're really hitting colleges hard. I know when I was in college, I had a bunch of MLM schemes try to recruit me to sell their products. Steer clear. I tell most people a general rule of thumb is if it sounds too good to be true and it sounds like the most amazing thing that you have to do it because you'll be missing out if you don't, completely avoid it. Because, what's up, Bryce?
I'm actually an African prince, if anybody needs to.
Yeah.
But,
So,
I got your email and I got
yeah. So that's the thing. I mean, and so they're getting better and better at it because a lot of these things are very believable. I know I had a client who was talking to somebody who they were unfamiliar with for many, many months, and that person had never mentioned anything about what they were doing with investments. And eventually they convinced them that just in developing natural conversation, they eventually convinced them to ask about their investments. And this person said, oh, I'm investing in cryptocurrencies. And they said, oh, would you like to participate too? So this person was playing the long game. They took 3 or 4 months of getting to know this person and building rapport and building trust before they actually went through and implemented their scam. So they built the trust and then eventually implemented their scam and scammed them out of, hundreds of thousands of dollars because they had built that trust so strong over the course of that rapport they were developing. So my point is, it's not as basic anymore as the foreign prince that's asking for money. They're becoming very elaborate and very complex, and so sometimes it's hard to know what's real and what's fake and what's a scam. So just be aware of that and tread with caution. But that pretty well does it for my presentation. I don't know how I'm doing for time, but I appreciate all of you guys bearing with me. Perfect.
So we'll do a final prayer, and then if anyone wants to ask Cody any
Sure.
questions afterwards, just so we can.
Could you put your URL on the board?
Oh, yeah, I'll do that.
Picture of it?
Sure. Here, I'll put,
I think you got cards too, don't you?
I have cards. So my cards are actually, when I was doing mostly asset management, my cards are info on my registered investment advisory company. I'm not really doing much of that anymore. I mostly encourage or I feel passionate towards helping other people learn how to invest themselves rather than being paid to do it for them. So feel free to look at this info, and the email will get to me, but I'll put my more recent or more relevant information on the board here for my accounting company, which I'm mostly doing, tax prep work, tax planning, tax strategy. But
You said you had a website where they
I'll put that on the board. There's a lot of good stuff on that website, and what I want to do for anybody that's part of the parish is if you guys have tax-related questions or just general financial planning questions, I'm happy to hear you out on it, and I'll seek an answer for you and happily give you an answer. I'm not going to charge for it, but what I'd like to do is be able to post on this website that I'm going to write up here what I found with that, and I'm not going to put your name in it, so it'll be completely confidential. But I want to start creating use cases for people to reference, and if it applies to their situation, hopefully get some insight and some advice to be able to apply to their own financial situation. So I'm hoping to provide a lot of educational content so that if people are interested, they can do a lot of the due diligence and the work themselves to be able to hopefully better their financial situation. So I'll put that URL right now. We have good, honest tax.
That's a great name.
Thank you. .com. All right, and then I'll put my phone number up here. My good old Oregon number. So if you get a 503 number, it is not a telemarketer.
Cody, how you spell your last name?
Roos. So it is CODYROOS. It is Roos. It's actually Dutch for Rose. So our daughter is named Rose, essentially. All right.
Thank you so much, Cody. That was a lot of information. Very, very good. Thank you. In the name of the Father, and the Son, and the Holy Spirit. Amen.
Amen.
Glory be to the Father, and to the Son, and to the Holy Spirit.
As it was in the beginning, is now, and ever shall be, world without end. Amen.
The Lord be with you.
And with your spirit.
May Almighty God bless you, the Father, and the Son, and the Holy Spirit.
Amen.